I'm Siddhartha Dash. I'm the chief researcher at Chartis Research, and we're gonna I'm going and I have Kevin King with me today to talk about alternative credit data. Kevin is the vice president of credit risk solutions at LexisNexis, and we're going to have a fairly interesting discussion about a topic where the industry views and definitions are broad and widespread. So, with that, to level set, Kevin, could you define what alternative credit data means for LexisNexis? What's your definition, and how do you define it?
Certainly, Sid, it's great to be with you today. When I think about the broader credit data landscape, let's say there's maybe three categories in my head. There's traditional data, and I'll define traditional credit data as the data that's commonly used here in the United States in a FICO score or a Vantage score. Right. So national credit reporting agencies like Experian, TransUnion, Equifax, they offer alternative and traditional, but I would really point to the kind of trade line data that drives those FICO and Vantage scores as being traditional data. To me, that data is incredibly predictive. It should be a part of every lender's credit evaluation process. I think increasingly people just realize it may not be enough to gain competitive advantages making truly efficient lending decisions. Second category would be alternative credit data. And so to me, that is data that here in the US meets both all of the regulatory requirements of data from an FCRA perspective that would be used in taking adverse action on a lending decision. So the data is disputable, for example, that's going to be a really big one. This data also, though, needs to adhere to, let's say, the less formally enshrined rules that regulators increasingly care about. We know consumers care about. You can think about things like consumer transparency, for example. Will consumers understand why this data is being used to evaluate them? That's going to be a really important part of this. And the last category to me, and maybe we're providing the guardrails for alternative data, if traditional was on one side, experimental would be on the other. Right. And that's data which very well may be predictive of credit risk, but struggles with some of those regulatory issues, or has maybe a correlation but no causation, no true formal relationship with credit risk long term. So those are my three core buckets.
That's a really interesting and precise way of looking at it, because I think a lot of people think about experimental data only or the other bits only. Moving to another topic, if you will, given this sort of depth and breadth, of data available, and the data that, for example, Lexis makes available to its clients, which areas do you think are the sort of provide the maximum value from a signal perspective? And are there consumer segments that are more impacted by the availability of alternative data versus others?
Phenomenal question, Sid. And I would argue that the answers to those two questions may initially conflict a little bit. And what I mean by that is I think the consumer segment that this data has the most impact on may not be the consumer segment where lenders stand to realize the biggest ROIs from the use of alternative data. So I'll answer in that sequence. What consumer segments are going to be impacted by alternative credit data the most? I think inherently that's going to be consumers who are on the outside looking in terms of access to traditional financial products. So that's going to be credit invisible consumers who do not have a FICO or Vantage score. Right now, there's very little information in a traditional credit flow that would lend a lender to, or cause a lender to approve them. Alternative data can thus completely flip a decision and turn a no into a yes for that group. And subprime consumers are also to a certain degree in this bucket as well, because they're already sitting in the decline category. And is there additional information that might have big changes in their ability to access credit found in alternative data? So that's the biggest needle mover on a consumer segment population. I would argue, though, from a revenue impact, the biggest area for value in lenders is using this on near prime and prime consumers who are credit visible, who have a FICO score. That is where, look, let's be honest, the majority of applicants for most common financial tools are going to sit, and where the most competitive advantages tend to lie.
Given that, where do you see the most sort of what are the key business drivers that have been leading to the adoption? Is there anything which is the most powerful influence, if you will?
That's a really, really good question. So, look, I think the biggest for the last, let's take a 20-year perspective on this. Okay. So 20 years ago was when I would argue alternative credit solutions. So solutions that are designed to inform credit decisions beyond that of a standard classic FICO score, started gaining some momentum. And I would argue for, let's say, 2002 through 2020, the biggest drivers were financial inclusion, right? The desire to lend to consumers who have little to no data footprint or subprime footprint, and that could be because of lenders feeling regulatory pressures. That I think often is the case. It could be lenders who are feeling pressure from investors from a value standpoint, right? People love to say that financial inclusion is a core tenet of their values within a financial institution, but are you taking real steps? That kind of pressure often led to increased adoption of alternative data. And then competitive pressures, right? It is to some degree an untapped area of potential growth. But of course, I said that 2 years ago, we started seeing a shift. And that shift was when two big factors started creating momentum in the use of alternative credit solutions on thick file consumers, which is unquestionably the fastest growing use case for these kinds of insights. Those two pressures are, again, we'll bring up competitive pressure, right? We're looking for areas to drive growth, particularly coming out of the pandemic with more and more lenders in the game. How do you use alternative data to refine pricing and offer strategies to maximize your booking rate? Right along with that, you have all the innovations that have occurred in the financial technology space that have increasingly given consumers more of an ability to shop around for the best loan offers. And I'm saying loans, but we could be talking about credit cards, we could be talking about car loans and mortgages. A consumer's ability to get multiple offers and compare those offers has never been stronger. And with that comes more of a pressure on lenders to optimize the offers they're putting forth to consumers. And that's where alternative data and that additional visibility it gives above and beyond traditional data alone is driving the ROIs we talked about earlier.
So, in many senses, this is going way beyond just the origination of loans. It's going into the broader life cycle from pre-screening to to optimization. Would that be correct, and that your view as well?
It is. And again, I know I would still be candid that the majority of use, at least in the United States, still centers around account opening. But I think what you start to see at many lenders is it used to be hard. Hopefully it's getting a little easier, work with their internal compliance and governance teams to get certain data sources approved. And they start realizing the benefits of these signals at account opening. The natural question is, where else can I plug these insights into in my kind of customer lifecycle and drive real value, particularly again, now that some of the hurdles that made initial adoption time consuming have been addressed. Pre-screen, unquestionably, is the first place that lenders who are comfortable and getting sophisticated with alternative data are looking to use these insights next after account opening. And I think that's pretty obvious why that would be a case, right? We're still in a use case in pre-screen where the lender has very little information and very little firsthand exposure to a potential prospect or consumer. So they're really reliant on third-party data sources to get a read for the credit risk of those individuals. And so I would point that to be the next big area of the life cycle. That's it.
Yeah, and now so sort of swiveling away from the uses of alternative data. So we've seen data in origination across in financial inclusion and usage across the life cycle. But now looking at a slightly different lens to it, what are the pain points? What are the key challenges as institutions look to adopt the alternative data sets, if you will?
Yeah, Excellent question, Sid. And what I see is a set of challenges, some of which are common to the adoption of kind of any risk management tool. And then I think there are some challenges which inherently apply more in the credit risk space due to either regulation or the sophistication of use of the data. So first off, let's talk about the common challenges. Technology, right? I think as lenders are doing multiple transformations at once, right? They're transforming how they're engaging with consumers. They're also transforming how they ingest data, how they store data in the cloud, what kind of platforms they use, how they leverage analytics sandboxes. I think there's a lot of innovation happening, and the pace of innovation is going to change depending on the sector that your organization might reside in terms of, do I leverage a score? Do I continue to invest in internal data science assets? So we build our own credit scores, and we want to ingest kind of the raw attributes versus buy a credit score directly from another provider. Answering those questions is something that I think at first glance can appear daunting to many organizations. Now, I would say it's incumbent on companies like LexisNexis, and we invest a great deal of time in this, to be prepared to meet any answer to the questions I just posed that a lender might arrive on, right? They want to leverage our insights in a certain sandbox. It is incumbent on us to have our data in that sandbox. They want to leverage us via batch versus an API. We should be able to meet those needs. We should be able to live our data in scores and in attributes, so that no matter what, the core insights we provide, and I think at Lexis on the credit side, first and foremost, we're trying to distinguish ourselves based on the quality of the underlying data behind our products, can get into and have the appropriate influence on our clients' lending strategies. So those are the common things, right? And I think if you're listening to this webinar right now, you may say, I think about those same issues when I'm thinking about fraud solutions or compliance solutions. Absolutely. Then we have the things that are more specific to credit risk, right? I think there is a lot of work and increased scrutiny, although it's starting to apply in the fraud space as well, to new solutions around issues of model governance and compliance. And of course, that applies to attributes and scores. On our end in Lexis, our guiding philosophy is complete transparency, right? We have probably a 30, 40 page at least manual that we provide at the very start of any engagement that details exactly what's going into our scores, how they were developed. We have over 100 pages on our attributes going into exactly what's in them, how they're being calculated. The notion of intellectual property, if you're a provider like LexisNexis in the alternative credit space, I think cannot exist. That's the only way you help lenders get over some of those kind of compliance and regulatory challenges, which candidly have increased here in the U.S. Under the current administration. So, that's something that's a lot more credit specific that we think a lot about. And all of these are addressable, right? But if you're choosing sound partners as you kind of go through the alternative credit data journey, your partner should have answers to those challenges.
I think that makes sense. It's the business strategy that should drive the decisions, not the strategy of how the data is available or the technology strategy. But having said that, do you think that the regulatory environment today is going to impact how people will use alternative data? How do they leverage alternative data? And is their strategies changing because of the regulatory ecosystem as it stands today?
My hope is, and we've seen this in past iterations of the CFPB. I think about let's call it version 1 of the CFPB in its first iteration under the Obama administration. One of the scariest periods of time for those of us in the industry around then was not knowing what they cared about, right? So in some ways, I think the more the CFPB talks about these issues and clarifies their stance, and that is everything from alternative data specifically to their positions on AI and machine learning, which I think have gotten a lot more clear in the last 12 months. It reduces uncertainty and gives everybody a pretty clear rule book on what to follow. Serious providers in this space, and certainly LexisNexis considers ourselves to be just that, we're prepared to address just about anything, right? I mean, our data asset is robust. If for whatever reason they were to get uncomfortable with one type of data signal in our products, we have hundreds of different signals, hundreds of different consumer behaviors that we're looking at. So we've diversified our position from that standpoint, and then we just need to be nimble, right? So if we do get new guidance that challenges our products, and we haven't had that, but we try and keep our finger on the pulse, we're ready to adapt. And again, this is another one of those things that it's incumbent on the provider to be nimble and help solve this problem for financial institutions.
Okay, so basically, you've got the current risks, sort of provided for. You've prepared for shifts in the regulatory environment. But how do you see the industry moving forward? What do you think are the uh, big elements that you will see going forward? And where we will see success in the next sort of year, 2 years, in the next sort of ongoing period, if you will?
Yeah. So maybe I'll break that into two answers, Sid. God
Sure.
forbid I give you a straightforward answer, right? How do I think that the challenge in use among financial institutions may evolve over the next, let's call it 3 to 5 years? And then what are providers like LexisNexis? And I think many people watching the call will likely know we're the largest provider of alternative credit solutions in the United States by quite a margin. What are we doing to advance our capabilities and better arm consumers for the kind of reality that we're anticipating 3 to 5 years from now? Lenders first. I think lenders have went through a journey over the last 15 years that has gotten them comfortable to a point where the use of alternative credit data for financial inclusion, so on credit invisible consumers, or maybe to pull in near prime and slightly subprime consumers who are underestimated by traditional data alone, that's become a best practice. Everybody is comfortable with that. And what I think you're going to see over the next 3 to 5 years is the best practice use of alternative credit data continue to expand, right? And we start seeing that the use of these signals on essentially every applicant that makes it to your credit screening portion of the origination flow are going to get screened by some type of alternative credit product. We touched on pre-screen. I think that's also a pretty natural piece, particularly on the inclusion angle, right? But the ability to refine offers to increase response rate, identify underserved populations that actually meet credit criteria, all of that, I think, pretty naturally plays into that space. Portfolio feels longer off to me. I don't think that's coming in the next 3 to 5 years. On the provider side, it's incumbent on my end. I mentioned we look at hundreds of different consumer behaviors in our effort to paint a more complete view that augments the depiction of consumer credit risk you get from traditional solutions today. We need to keep looking at more and more new signals. We need to be looking at that experimental bucket that I mentioned earlier of data and say, what can be done to potentially mature some of those signals and get them to a point where they can be responsibly included in the kind of solutions like RiskView, which is the lead alternative credit solution at LexisNexis. That's going to be a really, really big aspect to how we operate going forward. I'll mention one more, and then I promise I'll throw it back to you, Sid. There's work to be done on the consumer understanding portion of this. We don't state the number of consumer credit reports that we do publicly at Lexis, but I'll tell you it's in the many hundreds of millions, and that's maybe putting it lightly, from LexisNexis here in the United States every year. Right? That number is going to grow significantly, not just from Lexis, but from other providers who are entering the space. And we need to make sure consumers are aware of these signals. They know how to influence and conduct themselves responsibly to kind of improve their standing in the same way they understand how to do that with a FICO score. That aspect is going to be really, really key. You can add lawmakers to that list of people, but the education to the world outside of financial services and risk management needs to step up here, because alternative credit data is just going to be part of every credit evaluation in the years to come.
Thank you, Kevin. I think that brings us to a sort of a very informative close of a very informative ride, if you will. We started with the definition and a little bit of history, then look throughout the life cycle of the entire consumer cycle, look through a glimpse on the regulatory front, and then finally look at way forward, looking at things such as the extra behavioral cycles that we need to look at, insights we need to look at, and finally, good reason why alternative data is not alternative anymore. It is a core part of the equation, if you will. So with that, I think we close here, and thank you very much.
Sid, it was an absolute pleasure. Thank you so much for having me.